Hello friends, good morning to all of you, and this is the second session for the asset classification and the provisioning norms. So we are covering the module D of the BFM. Already have covered the module A, B and C, and module D here is, and it's very much important. Like this chapter is very much important from the module D. That's about the asset classification and the provisioning norms. So we will be covering the numerical part also today. So make sure to watch this video till end. And if you have not subscribed to the channel, make sure to subscribe the channel and press the bell notification icon so that you get updated whenever we upload the new videos. Complete crash course of the CAIIB is available. Just simply need to WhatsApp CAIIB crash to the number 83609 and I'll be sharing all the details with you. I'm also going to share the app link in the chat box from where you can be downloading the application. And if you're iOS user, use the ORG code GEGKT. So audio video quality working all fine. So let's start the session. The next topic that we are going to cover today, it's the PCR. That's the provisioning coverage ratio. All these topics are very much important. The topic that we are going to cover today, it's about the PCR, provision coverage ratio. So provision coverage ratio is going to indicate that to what extent the bank has made the provisions against the gross non-performing assets. So let's say the gross non-performing assets we are having up to one particular point, right? And for you, these GNPAs, we are using what extent of provisions? We are using what type extent of provision? That is your PCR. The formula is very much simple. It's like total provision divided by the gross NPA. So it is total provision divided by the gross NPA. That is the formula multiplied by 100. That's it. Right? So this is the formula. So what do you mean by total provision? Total provision means we are talking about the provisions made for the NPA. Like we will be covering the specific as well as the floating provisions both. And when we are talking about the gross non-performing asset, it means the total non-performing assets before deduction of the provisions. So we are not to deduct the provisions and the total NPA amount. That is your gross NPA. What is net NPA? Total NPA minus the provisions, that is your net NPA, right? So getting the difference, and it is a requirement that we have to maintain the around 70% is the benchmark level as per the regulatory perspective. As per the regulatory perspective, it is 70% of the PCR is to be maintained, right? And higher PCR means if a bank is having the higher PCR, what does it means? It means strong provisioning is there, better financial stability will be there. And if a bank is having the low PCR, it means higher risk is there with that particular bank. So if the bank A is having 56% of the PCR, bank B is having 63% of the PCR, which one would be considered better? Bank A or the bank B? Do reply at the earliest. Which bank would be considered better? Bank A or bank B? It's the bank B. Why? Because bank B is having the more strong provisioning. It is having the better financial stability, whereas the bank A is having the higher risk involved. Inadequate provisioning is there, right? So this is what we can indicate from the PCR levels. Okay, now let's move ahead. It's about the willful loan defaults. It's about the willful loan defaulters, right? So there was a working group on the willful loan defaults, which was established. And what loan is said to be the willful default? Like where the borrower is having the capacity to repay, but is not trying to repay, is do not want to repay, or let's say they are diversioning or siphoning of the funds, like the funds were issued for some particular purpose, but they have not been using for that particular purpose, or they have totally like used it for the unwanted purposes. or it may be the case that what the security was created using the funds that has been disposed of. The security has been disposed of, that has been removed. The secured assets have been removed without the bank's consent. So these could be the reasons related to the willful default, right? So a willful defaulter is a person like who deliberately defaults in repayment despite the repaying capacity, or they misuse the funds, or they divert the borrowed funds. And there is a definition which is given as per the SS Kohli working group. As per the SS Kohli working group, a definition is given like borrower is classified as willful default if three of the things are there, like if you are having the capacity to pay but you do not pay. That's the first part of the definition. The second part, it's related to if there is diversion of the funds or siphoning of the funds. Siphoning of the funds. And the third one, it's related to disposal of the security. So if any of these three things are there, it means there is willful default. And what is the cutoff limit for the willful default? It is rupees 25 lakh rupees. The cutoff limit is 25 lakh rupees. Like means only accounts with rupees 25 lakh and above outstanding balance, those are considered for the willful defaulter classification and the penal action. Like for those accounts where the balance is below 25 lakh rupees, the penal measures won't be applicable. Those would only be applicable when the loan amount is 25 lakh or above. So there are some penal measures. The one, it's related to the credit ban. It's related to credit ban. Like no additional facilities will be sanctioned from the bank or financial institutions. And particularly for the 5-year period from the date of publication, from the date of publication in willful default, this credit ban will be imposed. And this credit ban will be there for new ventures as well as for the existing businesses. Like if for any of the new ventures they are floating, or any of the existing businesses, this credit ban will be there, and this will be there for a period of 5 years. Now, the lending institution can be formulating a policy. They can be formulating a policy with the approval of the board of directors. With the approval of the board of directors, they can be having a policy like for the transparency purposes. Like they can be doing what? They can be even be publishing the photographs of the defaulter persons on their website, or even can be showcasing in their bank premises. But there should not be any discrimination, and it should be consistent for all the willful defaulters. Right? And what regulatory action can be taken against the willful defaulters? Like the legal action should be initiated as soon as possible. The legal action should be initiated. And the bank can also be going for the criminal proceedings. The bank can also be like reaching out for the criminal proceeding, like if the fraud is there or siphoning of funds is there, and the same is to be reported. The proper reporting is to be done. The reporting is to be done to the Reserve Bank of India, to the CIBIL, to the CRILIC, and whosoever the directors were there, promoters were there, they should be restricted from the institutional finance. They should be restricted from the institutional finance, right? So that's the case. Now after that, let's have a look at the questions. Quite important. Make sure to answer these questions side by side. And further, you need to write the question number along with the option. Like if you want to answer A, you should be writing 1A for the question number 1. Okay. So the question number 1, it says the rate of provision on standard loans is given correctly in which of the following? The rate of provision is given correctly for which of the following? Agricultural loan, it is 0.25%. MSc loans, it is 0.25%. For other loans which are not specified, 0.4%, all of the above. So which one would be the correct answer? Question number 1, which one is the correct answer? So I've already told you for the different categories, the provision which is to be maintained, this is for the standard loans. For the standard loans, even the provision is to be maintained. So what will be the answer here? For agricultural loans, 0.25%. Yes, correct. For all the direct agricultural loans, it is 0.25%. For micro small enterprise loans, it is 0.25%. Again, correct. Other loans which are not classified or specified, for that 0.40% of the provision is to maintain. Again, correct. So the answer is option D. That is all of the above. So for the question number 1, option D is the correct answer. Question number 2, it says, in case of the unsecured substandard loans, to make provision, which of the following is not stated correctly? Which of the following is not stated correctly? So for unsecured substandard loans, we are talking about unsecured substandard loans. So for substandard loans, the two provision rates were applicable. Two or three? Three. How come? The first one was related to secured substandard. And for secured substandard, 20%, sorry, 15% of the provision was applicable. And the second category was related to unsecured. And the third one was related to unsecured but infrastructure. For unsecured substandard, it is 25%. And for related to infrastructure, it is 20%. Like this is related to unsecured substandard loans. So rate of provision is 25%. We are to tell which one is not stated correctly. So option A is correct. Rate of provision for infrastructure based accounts 20%, correct. To calculate the provision, the balance will be bifurcated into secure balance and the unsecured balance. Is it the case? No. We are to look that whether the account is secured or unsecured. And that can be checked by looking at the security that was available ab initio. So this point is not correct. So that will be our answer. So like the case was very much simple. If it says that if we are having the value of security up to 10%, then we say the account to be unsecured. If the value of security is up to 10%, we say the account to be unsecured in that case. And if the value of security is if the value of security is up to 10%, we say such account to be unsecured. But if the value of security is greater than 10%, we say such account to be secured. Right? Then we say such account to be secured enough. So one rate of provision will be used for the entire balance, will be classifying the account whether it is secured or unsecured, not like that will be bifurcating the balances. So there is no bifurcation of the balances when we're talking about the substandard loans. So option C is the correct answer. What is the rate of provision? The question number 3, it says, what is the rate of provision on secured substandard accounts? For the secured substandard accounts, what is the rate of provision? 0.40%, 15%, 20%, or 25%? What it is? It is for secured substandards, it is 15%. So answer is option B. So answer is option B. Now let's move toward the question number 4. Question number 4 it is. So we are provided with the outstanding balance in the substandard account of rupees 20 lakh, value of security 16 lakh, and what is the amount of provision that we need to maintain? So what will be the answer? So see, we are provided with the outstanding balance 20 lakh rupees. Value of security is given to you. So first thing that we need to check the value of security. Like if the value of security is lesser than or equal to 10%, then it is a case of unsecured substandard account. And if value of security is greater than 10%, then we say the account to be secured account. And 10% of the outstanding balance is 2 lakh rupees. So definitely the value of security is above, way above than 2 lakh rupees. So it is secured substandard account. So we'll be saying such substandard account to be secured substandard account. And when the account is secured substandard account, when the account is secured substandard account, in that scenario, the provision which is applicable is 15%. And this 15% provision is applicable on the complete amount. On the complete loan amount, this provision would be applicable. So it is 20 lakh multiplied by 15%, that is equal to 3 lakh rupees. So this is the amount of provision that we need to maintain. Getting it? So first of all, we are to identify whether the loan is secured or unsecured, and accordingly we are to calculate. So here the option A will be the correct answer. Let's move further. It's related to the question number 5. Question number 5, here it is. The outstanding balance in the substandard account is 20 lakh rupees. Value of security 2 lakh rupees is the date of sanction. What is the amount of provision? So when you just identify that the loan account category is substandard account, then you will be first of all looking into the value of security. Now here the value of security is just and just rupees 2 lakh, and the 10% of 20 lakh, that the sanction amount or the outstanding amount is 2 lakh, is basically we have to look into 10% amount of it, right? So this amount is up to 10%. The value of security is up to 10%, means it is secured or unsecured. This substandard account will be considered secured or unsecured. Do answer at the earliest. It is unsecured substandard asset. So when it is related to unsecured substandard asset, and if it is not related to infrastructure, will be considering the provision of 25%. So 25%, because this is unsecured. So 25% of the provision is to be maintained. On what balance? On the outstanding balance. So 25% of 20 lakh rupees means 5 lakh rupees. So this will be the answer. Rupee 5 lakh would be the answer here. Question number 6. The rate of provision on doubtful loan is stated correctly in which of the following case? Option 1, it says DF1 on unsecured portion is 100%. On secured portion it is 20%. Is it correct? No, because on DF1 for unsecured, see, for doubtful category, for all the doubtful categories, DF1, DF2, DF3, for the unsecured loan it is 100% for the unsecured, like where there is shortfall in security. But for the realizable value of security for DF1 it is 25%. For DF1 RVS, realizable value of security, it is 25%. So option A is correct, incorrect. Option B, it says for DF2 unsecured portion 100%, secured portion 40%. Absolutely correct. This one is absolutely correct. So option B is correct. Like for the secured one, it is 40% for the RVS, And for the shortfall, it is 100%. For DF3, it is 100%. Whether it is secured, unsecured, doesn't matter. It is 100% for DF3. So option C is also not stated correctly. So answer for the question number 6 is option B. Question number 7 it is. Question number 7, it says to calculate the secured balance in case of the doubtful loans, the following security is not to be considered. The following security is not to be considered. So which one is not considered? The primary security, collateral security, guarantee from CGTMSC, DICGC or ECGC, or personal guarantee of the third party or the promoters. Which one is not considered? See, the primary security is considered, the collateral security is considered, the guarantee cover is also considered, but this personal security is not considered related to the personal guarantee or the third party guarantee promoter. It's not considered. For the calculation of the provision purposes, it is not considered. It can be taken, but for the provisional purposes, it is not considered. Right? So the question number option D is the correct answer. Question number 7, option D is the correct answer. Next question says a doubtful up to 1 year. A doubtful up to 1 year has a balance of 20 lakh rupees. The security value is 16 lakh rupees. What is the amount of provision? So we are having the doubtful up to 1 year. When we are saying doubtful up to 1 year, means we are talking about the DF1 category. Means we are talking about the DF1 category. And under the DF1 category, if you memorize, we are having the two types, realizable value of security or the shortfall in the security. For realizable value of security, the provision which is to be maintained is 25%. And for shortfall in security, 100% of the provision is to be maintained. Right? Now we know the outstanding balance is 20 lakh rupees. And also we are provided that the value of security is 16 lakh rupees. So the secured amount is 16 lakh rupees. Right? And the unsecured amount is 20 minus 16 lakh means 4 lakh rupees. So we have to add them up all. So for realizable value of security, 25% of 16 lakh means 4 lakh rupees. And 100% of 4 lakh rupees means 4 lakh rupees. So the total provision that we need to maintain for the secured component, we are to maintain a provision of 4 lakh rupees. And for the unsecured component, we have to maintain a provision of again 4 lakh rupees. So the total provision that we need to maintain is what? It is 8 lakh rupees. It is 8 lakh rupees. So the answer for the question number 8, it will be option C. Option C is the correct answer. The answer is option C. Let's move toward the question number 9. Try to answer these questions at your own pace. So question number 9, it says a doubtful up to 1 year. We are talking about DF1 category has a balance of 20 lakh rupees. The primary security of rupees 8 lakh available, collateral security of 8 lakh available, third party guarantee of 12 lakh available. What is the amount of provision? So whenever we are talking about the doubtful, right, we know the provisions now, like for the secured component, for the RVS, realizable value security, we are to maintain 25% of the provision. For the shortfall in security, we have to maintain 100% of the provision. Now the secured components, if we look at the total amount which is secured, like primary security is available, amounting for the primary security, what amount is available? It is 8 lakh rupees. 8 lakh security primary, and collateral security 8 lakh rupees. And the third party guarantee net worth is 12 lakh rupees. Would it be considered for the provisioning purposes? No. I just told you that this is not considered. So the total security available is 16 lakh rupees. It is 16 lakh. So the realizable value of security is 16 lakh and shortfall is 20 lakh minus 16 lakh means 4 lakh rupees. So 25% of 16 lakh means 4 lakh. plus 4 lakh means total of 8 lakh of the provision is to be maintained. So the answer will be option C. 8 lakh of the provision is to be maintained. 8 lakh of the provision is to be maintained. So question number 9, option C will be the correct answer. Now let's move toward the question number 10. It says a doubtful above 1 year. Now when it simply is indicating above 1 year, we are talking about the DF2 category, because in DF1 category, the account remains for 12 months. And after that, it is shifted toward the DF2 category. So we'll be assuming that the account belongs to the DF2 category now, right? And in the DF2 category, if we look at the realizable value of security, 40% of the provision is to be maintained. And for the shortfall in security, for the amount for the shortfall in security, 100% of the provision is to be maintained, right? So here is given that we are having the balance, outstanding balance 20 lakh rupees, value of security 16 lakh rupees. So 16 lakh will go toward the realizable value of security, and 20 lakh minus 16 lakh, that is 4 lakh, will go toward the shortfall in security. So it is 40% of the 16 lakh that will be amounting to, let's just calculate 16 into 40%, that is 6.4 lakh. So 6.4 lakh toward the realizable value of security plus 4 lakh toward the shortfall in security. So it is 10.4 lakh. 10.4 lakh. That is what? That is your provision which is to be maintained for this account. Right? The next question, it says a doubtful above 3 years. Doubtful above 3 years. Like for, see, if even if this is not mentioned, then even we should be identifying that if it is belonging to DF3 or what category. Like for up to 12 months, it remains under the DF1. And for the next 24 months, it will be remaining under the DF2. And greater than 36 months, it will be under the DF3. So now the account is belonging to DF3 category. And if you memorize for the DF3, whether the account is secured or unsecured, doesn't matter. We have to maintain 100% of the provision. 100% of the provision is to be maintained. So here, the loan amount is 20 lakh rupees. So 20 lakh rupees of the provision is to be maintained. Right away, the answer is option D. The answer is option D. Now let's move toward the question number 12. A doubtful above up to 3 year mean DF2 category loan has a balance of 30 lakh rupees. The security includes the primary security and CGTMSC cover of 80% is available. Now see, first of all, we have to identify that what is a secured loan account balance. What is a secured loan amount balance? Here it is. And the most important part that we should be remembering from this question is related for the amount for which the cover is available. Cover is available from any of the institution that is not to be considered for the provisioning purposes. Like the total balance is 30 lakh rupees, right? Total balance is 30 lakh rupees. And the secured primary security is available for 10 lakh rupees. And the value for which security is not available is 20 lakh rupees. So here the cover would be available. Like for CGT MSC cover, CGT MSC cover of 80% is available here. So 80%, 20 lakh into 80%, that is 16 lakh. 80% of 80% cover is available. So 80% of 20 lakh rupees is 16 lakh, right? We have to subtract that. So 4 lakh is the amount which is for which no cover is available, for which no security is available, right? So 80% of the CGTMSC cover is amounting to 16 lakh rupees, for which cover is available and for which the provision is not to be calculated. So we have to calculate the provision for the 10 lakh, the secured amount for which the security was available. It is DF2 category, so it is 40%. and for unsecured amount at 100%. So 10 lakh into 40% means 4 lakh rupees, and 4 lakh unsecured means 4 lakh rupees. So total 8 lakh of the provision is to be maintained. So let me repeat you again. First thing first, that we are not to maintain the provision for the CGTMSC cover. We are just to subtract the covered amount from the unsecured balances, right? So that we can reach the that particular amount for which no security or no cover is available. And that we calculated, like first of all, we subtracted the security amount. That was primary security which was available, amounting 10 lakh rupees, and 20 lakh was the amount that left. Like first of all, we just calculated we separated the primary security or other securities. We were left with 20 lakh rupees, and we then separated the cover amount from it, that is 80%, and we left with the unsecured balances. Let's For the amount for which no security is available, that is 4 lakh rupees. Now we are having the secured balance of rupees 10 lakh here, and the unsecured balance for which no security is available is 4 lakh rupees here, and we calculated the provision accordingly. The next question, it says a doubtful up to 1 year. Up to 1 year means we are talking about DF1. Account has a balance of 40 lakh rupees. So the total balance is amounting 40 lakh here. It is 40 lakh here, the outstanding balance we are talking about, right? The security includes primary security. So the primary security is available 10 lakh rupees. The collateral security is given to be 10 lakh rupees. And also the ECGC cover is available of 60%, right? So this is a secured balance. Like this is the realizable value of security. This is the RVS that is available. So if we subtract this from the total amount of 40 lakh rupees, we are left with 20 lakh rupees. And we are now to adjust the cover, which is available at 60%. So we are to subtract the ECGC cover. ECGC cover of 60% is to be subtracted. That is 20 minus 12 lakh, that is 8 lakh rupees. So 20 lakh minus 60%, that is 8 lakh rupees. Okay. Now this 8 lakh is showcasing what? This is showcasing the shortfall in security. This is indicating the shortfall in security. For this balance, no security is available. For this 20 lakh rupees, the amount is available. The security is available. So it is related to DF1. So for DF1, we'll be doing what? We will be calculating this provision at 25% for 20 lakh rupees. And for shortfall in security at 100%. The provision is to be calculated. So 25% of 20 lakh rupees means 5 lakh rupees. 100% of 8 lakh means 8 lakh rupees. So the total amount, it will be 13 lakh. 8 lakh plus 5 lakh, that is equal to 13 lakh rupees. So the answer is 13 lakh here. So option B will be the correct answer. Option B is the correct answer here. Clear with it? So this is how we need to solve the questions and numerical questions related to non-performing assets. And definitely the one will be asked to you in the exam. Now after that, it's about the question number 14. So banks are required to maintain an overall provision coverage ratio of what percentage? It is 70%. Answer is 70%. It is a benchmark. It's a benchmark that all the banks need to maintain the provision at, PCR at. So that will be related to the chapter number 3 from the module D. And the next chapter that we're going to start from the module D, it's related to the liquidity management. It's related to the liquidity management, the chapter number 4 from the module D of the BFM. It's about the liquidity management. So do confirm if you have understood the topics so far from the module D so that we can proceed with the chapter number 4. Right. So let's start with the chapter number 4 from the module D that's related to the liquidity management. So we are having some objectives of the liquidity management first of all. The first objective is related to the profitability. That whatsoever the funds are there, there should be optimal deployment of those funds, right? So let's say we are having the deposits with us. So we should be deploying the deposits in the particular lending, or let's say we should be investing it further in such a manner that we can be making most of the profit out of it. And the second thing about the liquidity management is related to what? That we must be having the liquidity available with us, that the funding should be available with us so as to meet the obligation. The funding should be available with us so that we are having the liquidity available with us so as to meet our obligations. So what is the meaning of liquidity? Liquidity refers that the bank is having the ability. So liquidity is what? It is the ability. And the ability to do what? Ability to do the withdrawals. Let's say whatsoever the withdrawals are there from the bank, we are having the capacity to pay such withdrawals, and whatsoever the loan demand is there, we are able to fulfill that particular part, and further we are able to generate the funds at a very reasonable cost. That is the ability. So liquidity is basically the ability to meet up the withdrawals, to make the payment for the loan demands, right? And so as to generate the funds, at a reasonable cost. At a reasonable cost, we are able to generate the funds. That's basically the meaning of liquidity is there, right? And also, we can be saying that a bank is having the adequate liquidity. We can be saying that the bank is having the adequate liquidity, like when the bank can be raising the funds by increasing the liabilities. Let's say we are increasing the liabilities and we are able to raise the funds. When the liabilities will increase, let's say when the bank is mobilizing more deposits, let's say when the bank is borrowing from the interbank market or something, right? Or it could be the case that the bank is selling the assets so as to generate the cash. So that's the basic definition of the adequate liquidity. And that we need to do promptly and at a reasonable cost. It's not the case that we are just generating the liquidity, but we should be able to generate it promptly. When required, we are able to generate it, and at a very reasonable cost, we are able to generate it. Then we say that we are having the adequate liquidity. That's a complete and proper definition related to the adequate liquidity. And when we're talking about the liquidity risk, what it is, like we are having the financial obligations, and when we are not able to meet up those financial obligations, when they become due, that is said to be the liquidity risk. And liquidity risk is very much normal in the banking operations, right? And in very, very, very extreme cases, it can be leading to the solvency risk. So when you're not having the ability to meet up your obligations, that is a liquidity risk. That's the normal part. But in the extreme cases, that liquidity risk will be leading to the solvency risk. Now, let's have a look at the dimensions and the role of the liquidity risk management. So as I told you that this is a process that we need to generate the funds so as to meet up the obligations, and that too at a very reasonable price and promptly whenever required, right? So the first part, it's related to the functions of the effective liquidity management. If we look at functions of the effective liquidity management, if we look at the first thing, it's related to market confidence. It's related to the market confidence. Like if you are having trust in the market or financial strength, then you'll be feeling safe about it. So it's about the marketplace, that the bank is safe and therefore is capable of repaying the borrowings, right? So it's kind of market confidence, first of all. Second thing, it's related to that we are having the ability to honor the lending obligation. That you are having the prior loan commitments. It may be the case that you have sanctioned CC limits of 1000 crores. The availed amount is 400 crores. Now people can be availing another 600 crores from you at any time. At any other time, they can be availing the liquidity from you. So that's the loan commitment we have to take care. That's also part of the effective liquidity management. And the third thing it's related to, so as to avoid the distress sale of the assets. We want to sell our assets, but we want to sell the assets at a reasonable cost, at not a lower cost. So it's about the asset protection, that we should be avoiding the distress sale of the assets. The fourth point, it's related to the that we should be lowering the risk premium on the borrowings. Like, we are able to generate the funds, but we are able to generate at a higher interest rate. So that should not be there. So we should always be taking care that the cost reduction is there. That the cost reduction is there. That is to be taken care of. Right? So these are the 4 points. First one, it's related to the market confidence. We can say that demonstrates the financial strength, right? The second one, it's related to the loan commitments, that we are having the ability to honor the lending obligations. Third one, it's related to that we should be avoiding the unprofitable sale of the assets. And the fourth one, it's related to that we are able to borrow but not at a premium cost. And the factors which will be determining the adequacy of liquidity, the factors which are going to determine the adequacy of the liquidity, what are those factors? Like, first of all, it's related to the historical funding requirements, that previously during this particular time horizon we required only this much funds. Now if you are having already that much funds, it means it is showcasing at the adequacy, the current liquidity position, the future funding needs, let's say if we are having any, the sources of funds, the options of for reducing the funding needs, or let's say the asset quality. Like, if you're having the good quality assets, definitely will be getting the repayments, and further we'll be having the adequate liquidity with us. The earning capacity, if it is increased, definitely we'll be having the adequate liquidity or capital position. So these are the points, those will be identifying that we are having the adequate liquidity or not. Then there are some factors that affect the bank's liquidity, the factors which do affect the bank's liquidity. The first thing, it could be related to that our earning is overall reduced, or let's say the NPAs have been increased, or let's say the deposit is concentrated, let's say the 1000 crore of the deposit was from the single institution only. What if they basically executed their embedded option? What if they never further they basically wanted the premature withdrawal or something? Definitely we'll be having the liquidity issues with us. Or let's say the credit rating is downgraded, right? So credit rating downgrade is there. So if the credit rating downgrade is there, people will be having the trust issues, and further they will be withdrawing much and more amounts. And also it may be the case that you have expanded the business opportunities, right? In that scenario, you'll be requiring much more funds for that particular purpose also. Or let's say you have acquired other entities, now the funds were used for that particular purpose, that's also going to affect the liquidity. Or let's say there were some new tax initiatives, or tax policy changes were there, now you have to deposit much more taxes, right? In that scenario, you will be having lower liquidity with you. So these are the factors which do affect the liquidity. The liquidity, like, if from a common man perspective, even if you think, like, if you're earning rupees 1 lakh per month, right? But now your earning is reduced to rupees 70,000, you'll be having lesser liquidity. If let's say you lent some funds to some of your relatives, and those are now gone, they are not paying you back, that's basically your NPA, and definitely that is going to reduce your liquidity. If let's say your CIBIL score is lower, you cannot be borrowing funds at a lower interest rate, your liquidity is gone. Let's say you basically bought some asset, or let's say you bought some company, definitely your liquidity is gone. And let's say the interest rate, the tax rate was increased from 20% to 60%, another tax burden on you, and you'll be having the lesser liquidity on you with you, right? So these are the factors which affect the bank's liquidity. which affects the bank's liquidity. And definitely you do require the funds, and definitely you can be performing any of these duties so as to have the funds. Like first of all, you can be selling of the assets, but definitely the unprofitable sale of the assets should be avoided. You can be doing the short term borrowing, like raising the funds from the money market. You can be reducing the illiquid assets. Like illiquid assets means like you can adjust the asset portfolio accordingly. You can increasing the term liabilities for raising the long term funds, right? Or you can be increasing the capital funds so as to strengthen your capital base. So these are the things which can be done so as to meet the liquidity needs. So as to meet the liquidity needs. So you will be disposing of your assets, you will be increasing the short-term borrowings or decreasing the illiquid assets, or let's say increase the liabilities in a term nature, right? Or it could be the case that you are putting into more of your owner's money into it, right? After that, it's about the types of the liquidity risk. Types of the liquidity risk. Now, if we look at the sources, we are having the two categories. One it is related to external risk, the other one it's related to internal risk. External liquidity risk means we are talking about the systemic risk. External, like if the liquidity crunch was with another bank due to which it is imposed upon you, or let's say if it is related to some geographical issues or something, or let's say if it is market related or something, that's the external risk. And when we are talking about the internal risk, that's institutional specific. Internal liquidity risk means it is institutional specific, right? Institutional specific reputation and perception risks. That's the part related to it. That's internal risk. Like in various market, if the risk is imposed related to it, that's basically the internal liquidity risk. Clear with it? Or I should be giving much more examples to you related to internal risk and external risk. So when we are talking about the external liquidity risk, it means the liquidity risk which is arising due to the external environment. That's basically beyond the bank's control, right? So it could be the case that the complete financial system is facing the liquidity crunch, or it could be the case that there are lack of buyers or sellers in the market. Like you want to sell the assets, but you are not able to do so. Or it could be due to the economical conditions like inflation is there, recession is there, interest rate shock is there. So on the other hand, when we are talking about the internal liquidity risk, it means the liquidity risk which is imposed due to internal factors within the bank. And this is institutional specific. It could be the reputation risk, like due to the negative news where the depositor confidence is lost and they are like withdrawing the money. Or it could be like short-term asset liability mismatch, or it could be like inefficient treasury operations, or let's say the NPAs are increased due to the reduced cash inflows, right? So that is a case. That is a case related to it. And there are the other categories of the risks also. There are the other categories of the risks also, like we are having the time risk, money risk, time risk, funding risk, call risk. So these are also to be taken care of. The first one, it's about the funding risk. The first one is the funding risk. Now funding risk is what? Let's say you are having an FDR of 3 years and against which you sanctioned a loan of 10 years. Now, after 3 years, the person is coming back to you, but you have already lent the money. Now you are having no funds with you. That's basically the funding risk. So funding risk is basically the inability of the bank so as to replace the net cash outflows when the liabilities fall due. Inability of a bank to replace the net cash outflows. That is basically what that is a funding risk, right? And this is a core liquidity risk. Funding risk is the core liquidity risk, right? So it could be due to the loss of funds which affect the liquidity. It could be due to the systemic crisis, right? The complete system is facing the issue. It could be, let's say, depositors basically withdraw money because of the loss of confidence, or it could be due to currency mismatch leading to funding losses, right? So it could be due to any of the things. The second type of risk, it is the time risk. The second type of liquidity risk, it is a time risk. Time risk means there is delay in the expected cash inflows. Like you were expecting that the cash inflows will be there, but there is delay into it, and due to which the timing mismatch is there, and that's going to affect the liquidity position. And there could be the multiple reasons. Let's say the asset quality is deteriorated, your loans are turning out to be the non-performing assets, or let's say the recovery delays are there, like due to the NPAs, due to the problems in the recovery, your asset quality is done, and you're having the weak credit monitoring, right? Let's say ineffective follow-up was there. So that's the case. And the third one, it's about the call risk. Call risk is basically related to crystallization of the contingent liabilities. Let's say you issued bank guarantees amounting rupees 1500 crore, and those just crystallize, you are to pay 1500 crore. Now definitely it's like conversion of the non-fund limits into the fund based like loans. Like there was crystallization of the non-fund based facilities, right? Like it could be also could be related to the derivative contracts, it could be related to the contingent exposure. So that's the case. So these are the types of the liquidity risks. Clear with it? Further, it's related to the interconnected risk scenario. It is related to the interconnected risk scenario. Now, interconnected risk means when the chain reaction is there. Let's say there was a big fraud in the bank, there was a big internal fraud in the bank, right? Due to which there is loss of confidence. There is loss of confidence. The depositors have lost their confidence in the bank, and now they are doing the withdrawals. Like what happened with the Yes Bank, right? And that led to the liquidity issue. That led to the liquidity crunch, right? Or it could be the case that the interbank default was there, like the banks in between who were dealing with each other. Let's say bank A was to repay amount to bank B, but bank A defaulted, and this will lead to the chain reaction. Now bank B won't be able to the bank B is not in the position so as to make the payments to the other banks, and ultimately it will be leading to the systemic risks, right? So that's the point. Further, it's related to measuring and managing the liquidity risk. So whenever we're talking about the risk, first of all, it's about the identification. And after that, the second one, it's about the quantification, that how we are going to quantify the risk. That how we are going to quantify the risk. So liquidity measurement and management is very much critical. Why? Because it's on continuous basis. It's like we have to meet up our abilities so as to meet the obligations, right? And there should be stability under the normal conditions as well as under the stressed conditions. And there's some elements which are very much important. Like first of all, we should be having a MIS. We should be having a management information system through which the timely and the accurate data is available so that we can make the decision that what liquidity, what amount of liquidity is required, at what cost it will be beneficial for us or something like that. And also we should be having the central liquidity control. Like centralized monitoring of the funds should be there. And definitely we should be analyzing of the net funding requirements. Like what is our net requirements? And we should also be looking at the alternative scenarios. Alternative scenarios means assessment under the multiple scenarios. It's not like that this much liquidity will be required on daily basis. It depends upon the multiple scenarios, that these could be the different scenarios under which the liquidity needs may change. And definitely we should be having the diversification of the funds, like multiple funding sources should be there. So there should be the diversification of the funding sources, and definitely there should be a backup plan for the crisis situation. Means contingency planning should be there. The backup plan for the crisis situation. So these things are to be taken care of. Like these are the key elements of the strong liquidity management, right? And further, what are the steps in the liquidity risk management? The first one is related to that we should be developing a structure for the liquidity risk management. A structure should be there for the liquidity risk management, and we should be setting up the tolerance limits and the tolerance levels, and we should be measuring and managing the liquidity risk. We should be measuring and managing the liquidity risks, right? So we are to take care of these things specifically. Then further, it's related to developing a structure for managing the liquidity risk. Developing a structure for managing the liquidity risk. The first part, like I just told you, that we should be having a uh, structure related to it. We should be having the limits and tolerance levels related to it, and we should be having we should be measuring and managing the overall liquidity risk. Clear with it? So the first thing, it's related to developing a structure for managing the liquidity risk. So we should be having a strategy for the same. We should be setting up a strategy, and that should be board approved, and there should be a policy framework. There should be properly a policy framework, and we should be monitoring. We should be having the monitoring and the control systems. So planning should be done in such a manner that we should be looking into the alternative scenarios, and we should be having the proper liquidity strategy, and further it should be an integral part of the business strategy. Let's say if we are talking about a liquidity strategy, it should be integral part of the overall policies. Integral part of the overall policies. And what should be the main objective of this particular strategy? What should be the objective? That we should be having the ability so as to withstand the stressed situations, right? And this particular strategy should be following the qualitative as well as the quantitative measures. Quantitative measures, like we should be having the we should be following the ratios, limits, tolerance levels, and qualitative means we should be having the proper policies and practices for this, and it should be covering all the assets and the liabilities for the same purpose, right? That's the case. So this strategy should be addressing the bank's goal. Like as I told you, it should be the integral part of the overall business strategy, right? And further, it should indicate specific policies, like the qualitative measures must be taken care of, the practices should be taken care of, and further it should be covering all the assets and liabilities, right? Means the scope should be related to covering both the assets, liabilities, as well as the funding mix, right? So that will be all related to this part so far, and further we'll be covering the rest of the part in the next video. So do like this video and further share this video, and make sure to WhatsApp us writing CAIIB to the number 83609 and I'll be sharing all the details with you. Thank you so much and see you again in the next video.